There are numerous books on investing for beginners, each offering different perspectives and approaches. Here are 5 widely recommended books that cover the basics of investing. Make sure to like this video and share for more videos like this. Number 1. The Intelligent Investor by Benjamin Graham. Often considered a classic, this book provides valuable insights into the principles of value investing. Graham's ideas, as well as commentary by Jason Zweig, make it a timeless guide for investors. The Intelligent Investor by Benjamin Graham is a seminal work in the field of investment literature, providing valuable insights and timeless principles for investors. The book, first published in 1949, outlines Graham's philosophy of value investing, emphasizing the importance of a disciplined and rational approach to the stock market. Graham introduces the concept of the defensive investor and the enterprising investor. The defensive investor is characterized by a more passive approach, focusing on minimizing risk through diversified investments in well-established companies. On the other hand, the enterprising investor is willing to devote time and effort to research and analysis, seeking opportunities for higher returns. One of the key principles introduced by Graham is the concept of margin of safety. This involves buying stocks at a price significantly below their intrinsic value, providing a buffer against potential market fluctuations. Graham advocates for a careful analysis of a company's financial health, looking for a track record of stable earnings and a reasonable level of debt. This book also delves into the psychological aspects of investing, underlining the emotional discipline and avoiding the pitfalls of market speculation. Graham introduces the allegory of Mr. Market, an imaginary character representing the market's mood swings. The intelligent investor is encouraged to take advantage of Mr. Market's irrational behavior rather than being swayed by it. Graham's influence extends to the concept of value investing, a strategy later popularized by his student Warren Buffett. Value investing involves identifying undervalued stocks and holding them for a long term, based on the belief that the market will eventually recognize their true worth. In addition to these fundamental principles, the book addresses various investment tools and strategies. It discusses the role of bonds, preferred stocks, and common stocks in an investor's portfolio. Graham also introduces the idea of the criterion of quality when selecting stocks, emphasizing the importance of a company's stability and earnings consistency. The revised editions of the book, updated by Jason Zweig, provide contemporary commentary that relates Graham's principles to current market conditions. This helps bridge the gap between the book's original publication and the modern investment landscape. The Intelligent Investor remains relevant today as a comprehensive guide for investors, offering a solid foundation for understanding the principles of value investing. Its emphasis on a rational and disciplined approach, coupled with a focus on long-term success, has made it a classic in the world of finance. Whether you are a novice investor or an experienced professional, Graham's insights continue to provide valuable lessons that stand the test of time. Number 2. A Random Walk Down Wall Street by Burton Malkiel. Malkiel explores various investment strategies and emphasizes the importance of adopting a diversified and long-term approach. The book is known for making complex concepts accessible to beginners. This book is a comprehensive guide to investment strategies and financial markets, offering a variety of insights for both novice and experienced investors. Published in 1973 and updated regularly, Malkiel's book explores various investment theories and advocates for a pragmatic, long-term approach to investing. The title, A Random Walk Down Wall Street, reflects the book's central concept that financial markets operate efficiently, making it difficult for investors to consistently outperform the market through stock selection or market timing. He argues attempting to predict short-term market movements is akin to a random walk, and success in the stock market is more a matter of luck than skill. The book introduces the efficient market hypothesis, EMH, which posits that all available information is already reflected in stock prices. Malkiel categorizes investors into three main groups: technical analysis, who study historical price patterns to predict future movements; fundamental analysis, who analyze financial statements to identify undervalued stocks; and random walkers, who believe in the efficiency of markets and advocate for a passive, index-based investment strategy. Malkiel explores various investment vehicles, including individual stocks, bonds, mutual funds, and real estate. He provides an overview of the risks and potential rewards associated with each, guiding readers on how to create a diversified portfolio that aligns with their financial goals and risk tolerance. A notable aspect of Malkiel's book is his advocacy for index investing. He argues that instead of trying to beat the market through active management or stock picking, investors can achieve satisfactory returns by investing in broad market index funds. This passive approach, according to Malkiel, not only reduces transaction costs, but also minimizes the impact of human emotions on investment decisions. The book also delves into the concept of the random walk itself, emphasizing that stock prices follow a random path, making it difficult for investors to consistently profit from short-term market movements. Malkiel uses the example of the efficient market hypothesis to argue against the effectiveness of technical analysis and market timing strategies. In addition to discussing investment strategies, Malkiel addresses behavioral finance and the psychological aspects of investing. He highlights common investor biases and mistakes such as overconfidence, herd behavior, and the tendency to chase performance. Recognizing these behavior pitfalls, Malkiel encourages investors to adopt a disciplined and rational approach to decision-making. The later editions of the book incorporate updates on modern investment tools such as exchange-traded funds, ETFs, and robo-advisors, as well as insights into the impact of technological advancements on financial markets. These additions ensure that the book remains relevant and applicable to contemporary investment landscapes. In summary, A Random Walk Down Wall Street serves as a comprehensive guide to investment strategies, emphasizing the challenges of consistently outperforming the market and advocating for a passive, index-based approach. Number 3. Common Sense on Mutual Funds by John C. Bogle. Bogle, the founder of Vanguard Group, introduces readers to the concept of index investing and the advantages of low-cost passive investing. This book is especially useful for those interested in mutual funds. To summarize, this is a seminal work that provides a practical and straightforward guide to mutual fund investing. Published in 1999, Bogle, the founder of the popular Vanguard Group, he shares his extensive knowledge and insights into the mutual fund industry, offering valuable advice for both novice and experienced investors. The book begins by outlining the history and evolution of mutual funds, shedding light onto their structure, costs, and the impact of fees on investors' returns. Bogle emphasizes the importance of minimizing costs, advocating for low-cost index funds as an effective way for investors to achieve broad market exposure without the burden of high fees. Central to Bogle's philosophy is the concept of index investing. He argues that actively managed funds which attempt to outperform the market through stock selection and market timing often fail to consistently beat their benchmark indices after accounting for fees. He contends that low-cost index funds, which passively track market indices, provide a reliable and cost-effective way for investors to capture market returns over the long term. The book provides a comprehensive overview of mutual fund performance, debunking the myth that past success is a reliable indicator of future performance. Bogle encourages investors to focus on factors such as expense ratios, turnover, and tax efficiency when selecting funds. He also discusses the impact of taxes on investment returns and the advantages of tax-efficient investing. Bogle addresses the importance of asset allocation in constructing a well-balanced investment portfolio. He addresses for a disciplined approach to long-term investing, discouraging market timing and excessive trading. Bogle's emphasis on the simplicity of a buy-and-hold strategy aligns with his overall philosophy of patient, low-cost investing. The book concludes with practical advice on building a diversified portfolio using a combination of stock and bond index funds. Bogle's common sense on mutual funds stands as a timeless guide, providing investors with a sound framework for making informed decisions, navigating the complexities of the mutual fund landscape, and achieving long-term financial success. Number 4. One Up on Wall Street by Peter Lynch. Peter Lynch, a legendary fund manager, shares his investment philosophy and insights. Lynch's approach focuses on investing in what you know and understanding the companies you invest in. This book shares the investment wisdom and strategies of one of the most successful fund managers in history, Peter Lynch. Published in 1989, Lynch's book is a practical guide that caters to both novice and seasoned investors, offering valuable lessons drawn from his experiences managing Fidelity Magellan Fund. Lynch's approach to investing is refreshingly simple and accessible. He advocates for individual investors to leverage their everyday experiences and observations when evaluating potential investment opportunities. Lynch introduces the concept of investing in what you know, encouraging readers to capitalize on their personal knowledge and insights gained from their everyday lives. The book outlines Lynch's investment philosophy, which is centered around the idea that ordinary investors have the potential to outperform professional fund managers by identifying promising stocks early on. Lynch debunks the myth that successful investing requires complex financial analysis, arguing that keen awareness of consumer trends, brand loyalty, and market dynamics can lead to profitable investment decisions. Lynch introduces various categories of stocks, such as slow growers, fast growers, and stalwarts, each requiring a different approach in terms of expectations and holding periods. He emphasizes the importance of understanding a company's story, financials, and growth potential before making investment decisions. A key aspect of Lynch's strategy is his focus on long-term investing. He discourages investors from attempting to time the market or engage in frequent trading, instead advocating for patience and a buy-and-hold mentality. Lynch shares anecdotes from his own career to illustrate how holding onto strong-performing stocks over the long term can lead to significant wealth accumulation. Lynch also addresses the significance of financial ratios and metrics, offering guidance on how to interpret them within the context of a company's overall health. He discusses the importance of a company's price-earnings ratio, or PE ratio, and earnings growth rate in the stock selection process. The book provides insights into the psychology of investing, with Lynch discussing common investor pitfalls such as overreaction to short-term market fluctuations and the impact of emotions on decision-making. Lynch's down-to-earth writing style and sense of humor make complex concepts more accessible to a broader audience. The book's emphasis on individual investors leveraging their own knowledge and understanding of everyday products and services provides a unique perspective on the art of investing. Whether you're a beginner or an experienced investor, Lynch's insights can inspire a more informed and confident approach to navigating the stock market. Number 5. The Little Book That Still Beats the Market by Joel Greenblatt. Greenblatt introduces the concept of magic formula investing, a simple strategy combining value and quality investing principles. The book offers a straightforward approach for beginners to identify potentially profitable stocks. The Little Book That Still Beats the Market by Joel Greenblatt is a concise and accessible guide to value investing, providing a straightforward strategy for stock selection. Published in 2010, Greenblatt's book introduces the concept of the magic formula, a systematic approach to identifying undervalued stocks with the potential for a strong return. The core idea of the magic formula is to focus on two financial metrics: earnings yield and return on capital. Earnings yield is calculated by dividing a company's earnings before interest and taxes, known as EBIT, by its enterprise value, while return on capital is the ratio of a company's pre-tax operating earnings to its tangible capital employed. Greenblatt suggests ranking stocks based on these metrics and investing in a diversified portfolio of the top-ranking companies. Greenblatt acknowledges that the magic formula is a simplified approach, but argues that it can lead to outperformance over the long term. He emphasized the importance of sticking to the strategy even during periods of underperformance, and highlights the power of compounding returns over time. The book provides a step-by-step guide to implementing the magic formula, including how to screen for stocks, construct a portfolio, and manage the investment process. Greenblatt's writing style is accessible, making complex financial concepts understandable for a broad audience. In addition to the practical aspects of the magic formula, Greenblatt shares insights into the psychological aspects of investing. He discusses the challenges of staying disciplined and avoiding emotional decision-making, especially during market downturns or periods of volatility. While the magic formula may not guarantee success, the book serves as a valuable introduction to value investing principles. By focusing on the fundamentals of a company's earnings and capital efficiency, investors can gain a better understanding of its financial health and potential for long-term growth. Remember that while books are a great resource, hands-on experience, staying informed about market trends, and continuously learning are also crucial aspects of becoming a successful investor. It's advisable to diversify your sources of knowledge and keep up with the latest developments in the financial world.